Sounds
There you
great.
go.
Well, thank you so much, everybody, for joining us today for our Skill Lab. Really excited for this one. We have got our presenter, Marla DiCarlo, who is the owner and CEO of BizNavigators. Marla has been in business for more than 30 years. She has a strong background in both accounting and financial consulting. She was also the co-owner of Raincatcher, which is a very large firm that does business brokerage in Denver as well. And she decided that she wanted to go and help a different set of businesses and started Biz Navigators. And so today she's going to be talking about what you should be thinking about before exiting your business. And with that, Marla, go ahead and take it over.
Yeah, thank you so much. So excited to be here today. Christy, real quick before I start, do we have the PDF to share with the
Yes, I will
participants
throw
today?
it in the chat.
Awesome.
Yes,
Thank
thank you.
you so much. Christy is going to upload hope, knock on wood, fillable PDF that you can utilize during this presentation because we're actually going to be not only going through some of the things that are important to know when it comes time to exit your business, but we're actually going to work on them as well. So happy to be here. This is where this is where you see my passion. This is where you're going to see me get really excited talking about this because I know how important this is. I was a CFO for about 10 years and then sold my company to a private equity group. And then, as Christy stated, started my first M&A company, Raincatcher, ran that for almost 10 years and then started Biz Navigators. And my focus is helping business owners below 5 million in revenue to exit their business or look for a new business. So what I find is that most business owners, and this is my fourth business, so I put myself in the same category as all of you. Most business owners were so busy running just the day-to-day operations of our business that we don't take the time to think about an exit. What does that look like? I call it tunnel vision, but there's a reason for it. We're always thinking about how do we get in the next sale? How do we find the next employee? And so I'm curious if some of you don't mind sharing, and you can either raise your hand or just hit the thumbs up emoji. I'm curious how many of you have thought about exiting but have not yet organized a plan? Thank you, Annie. Thank you, Megan. Appreciate you guys being vulnerable and raising your hand because what I'm going to tell you is that you're not alone. Stats, out there, most of them show that about 85% of business owners do not have an exit plan in place. And again, we're busy. We're trying to run a business. So today's session is going to be intentionally short, but action oriented. We're actually going to be writing and scoring, and then we're going to go through a 90-day plan that will help you to start to think about how do you start to work on your business. Because the other thing I want to share is whether you're wanting to sell 6 months from now, 2 years from now, 10 years from now, or not ever, as a CFO, I can tell you that these are the things that create not only a more profitable business, but it also helps you to have more freedom in your business. So you're not, tied to the day to day. So first, we're going to dive into what does exit readiness really mean? What is exit readiness? And for those of you again that would like to participate through the presentation, there should be a URL that you can click on or a PDF that you can download. It's fillable, and we're going to be taking some time to write our answers as we go through these exercises. So when we think about exit readiness, I want you to look through three different lenses. One is how transferable is your business, how financeable is your business, and then how defensible is your business. So transferability, that helps, that's where a business can continue to perform without the owner being the center of every decision. Like most business owners, at some point when we start the business, we are the decision maker. We do everything. We make the decisions around the customers, we solve the problems, we put together the processes, but buyers want to know whether or not that cash flow can continue and can transfer with the closing, or is it going to stay with the owner? And then financeability. Financeability asks, can a buyer, lender, or investor support the purchase price based upon clean financials, reliable cash flow, working capital needs, and reasonable debt service? Will the business support all of that? And a great business can still be very hard to sell if the numbers are difficult to prove, or most important, difficult to finance. I speak with a lot of business owners every day that have great businesses, but unfortunately, their cash flow does not support being able to pay for the debt service, and it's just not as sellable. And then defensibility. What protects the company's future cash flow? This may include customer loyalty, it might include recurring or repeat revenue, documented processes. Do you have a strong team? What is the differentiation in the market? What keeps new entrants and competitors from taking that business overnight? Do you have contracts? Do you have systems in place? Do you have a clear growth plan? So the key point is that buyers don't simply pay for a business, what the business did in the past. They want to pay for future cash flow that they believe that can continue even after closing. And the more transferable and financeable and defensible that cash flow appears to be or is, the more confidence that buyer has. So, which of these would be the hardest for your business to prove today? Think about, would it be difficult for you to transfer to transferability, financeability, or defensibility? And I want you to go ahead and just jot that down. Think about, is it harder for you to transfer because of owner dependency? Does your business not generate enough cash flow to be able to pay for new debt service or to be able to pay for itself? Or do you not have that unique differentiator in your business? And I'm curious if anybody wants to maybe share with the group what they wrote down. Was there, or maybe there was something that was surprising when I was going through that. Annie, I saw you took yourself off mute. Thank you.
I've always thought I had a transferability problem. But I'm realizing that that is not going to be as hard as the defensibility.
Mm. Yeah. Yeah, and it's not, it's very, thank you for sharing that. It's very common for business owners to have all issues in all three categories. But I will tell you, Annie, the most common is that transferability issue because we are the center of everything. And that's what we're going to go through today. So thanks for sharing that. Appreciate it. Okay, so I'm going to go in to talk about what are some of the drivers of value that you should think about. I'm going to help you to look at your business through the lens like a buyer does. And for me, the framework that I use is the value builder system. It looks at the 8 areas that influence how attractive the business is, how transferable it is, how valuable the business may be to a buyer. And so we're not going to overanalyze each one right now. Instead, what I want you to think about is this is a practical self check of your business. The purpose is not to label the business as good or bad. The purpose is to identify whether a business has risk, whether a buyer will see risk in the business, whether they're going to ask more questions. Most important, are they going to reduce the value? And so the 8 drivers, they help us to think about whether the revenue is recurring, whether the business depends too heavily on the owner, whether customers are concentrated, vendors, employees, maybe there's a concentration issue there, whether systems are documented, if the company can grow, is there growth potential, and whether the financial story is clear or believable. And one of the things I want to mention here is my framework that I use is the value builder system, but there is no right or wrong tool. Athena might use, Christy and Aggie might use a certain tool that helps to assess the business owner's value drivers as well. What I want you to focus on is those value drivers are how a business buyer is looking at your business. That's the lens they're looking through. And a low score doesn't necessarily mean that you have a bad business. It means that a buyer, again, might see risk and they might then require that that risk be addressed or explained or supported. And so oftentimes what you see with businesses that have lower value driver scores and lower scores and value drivers is that buyer might require that business owner to have some skin in the game. They may require more seller financing, more earnout versus just all cash at closing. And so, what we're going to do here is we're going to talk through the workshop about how these drivers can become more tangible to you, how you can start to look at them through the owner's lens, but not only that, where you can start to look at the areas in your business that have the most strengths, but then also those that might need attention before you exit the business. And so before we get into that, what we want to do is understand what is important, how a buyer looks at the business, and this is the first step. So one more step before we go into scoring the business, I want to start with something that's even more important. It's probably the number one area that I find business owners don't give enough attention to. And that is, what is the owner's goals when they are ready to exit their business? So this is where you can go ahead and pull out that PDF, and we're going to be on, let's see, page number 2. This is the first exercise. And before I start to talk about valuation, buyers, deal structure, timing, all of that, what I want to do is it's important to get clear on what you really want that exit to accomplish. There was a survey that was done a while back, but other surveys that have substantiated the stats. It was done by the Exit Planning Institute, and they found that 75% of business owners regretted selling their business. And I remember when that survey came out and my peers were so angry. I remember a couple of them even on my team saying, I can't believe that the exit planning would put something out there like that. I mean, that there's no way that's right. And I remember saying very boldly, I know it's right because unfortunately, a successful exit is not just about the offer. I get a lot of business owners that come in, they want a valuation, and that's very important when you're selling your business. But I actually turn that and I tell the business owner, you're asking me the wrong question. And they'll say, what do you mean? I'm like, you should be asking me if you're sellable because it doesn't matter if I give you a 3 million valuation. If you're not sellable, oh, didn't I tell you I don't have anybody to sell it to? So this is where you need to not only make sure your business is ready, but you also need to make sure that you're ready. And you need to make sure that that offer is going to support your personal, financial, and legacy goals. And so, what I want you to do is, I want you to take the next 3 to 4 minutes and I want you to write down your thoughts in each of these 4 areas: timing, role, outcome, and legacy. And when you think about timing, I want you to think about whether you would ideally like to step back and exit, or maybe you would want to continue with the future buyer and the future outcome of your business. And then for role, I want you to think about, are you going to leave completely? Do you want to stay involved? Do you want a transition period? Most transition periods are somewhere around 2 to 4 weeks. Sometimes that can extend out to 3 to 6 months. It just depends on the business, and it depends on how you've set up your business to transfer to a buyer. And so I want you to think about, what does that exit look like? Do you want to stay connected in some way? And then for outcome, I want you to think about what the exit needs to fund or protect. So that might be, maybe you have maybe you're using the sale for retirement. Maybe you have a family need. Maybe you have a future investment. Maybe you have something you want to do after you sell your business. Maybe you've got some debt you need to pay off. Think about what is the reason, what is the outcome of selling your business? What do you hope to achieve? And then the last theme is legacy. So I mentioned I had a CFO business that I grew, very much pioneer in doing that. And I was so ready to sell. I sold it in 2016 and I felt like I found the perfect group, and I did. It was a great group. But I had never been through the legacy action. I didn't realize how much of my identity was tied to that business. And what I mean by that is my employees mattered to me, my customers mattered to me. And it wasn't that I sold it to a bad group, I just would have done things differently. I didn't realize how important those things were to me until I went through that. So, what does your legacy look like? Does it matter to you beyond the price? And think about what is the outcome of the legacy that you hope to achieve when you sell. I think the prompt at the bottom of this says everything. What would need to be true for me to feel ready to exit my business? And so to think about those things, and I'm going to give you just a few minutes to write that down. There's no perfect answer. It's just what comes to mind today. One of the things that when I go through this exercise is I want you to notice that these answers are not soft issues. So there might be some of you that are kind of like, oh, I didn't realize I felt like that. What I can tell you is that how you answer those questions will directly affect the deal structure. And most important, it will affect the buyer. It's very important that if your timing is short, for instance, you might need a cleaner business and a more realistic valuation expectation in order to sell that quickly, sell your business quickly. If you want to stay involved, you might be open to rolling over some equity. You might be open to consulting with a new buyer. You might be more open to a phased transition. And for some, that's not even an option. For me, I realized that was not an option. I could no longer not be the decision maker in my business and continue forward with it. And then if legacy is important, that buyer fix, the buyer fit is just as important as the price. And 85% of the businesses that I work with, that legacy is a big thing. The thought of somebody taking over that business is just keeping that business owner up at night. So understand that, the cash at closing, the type of deal structure you have, the timing, is all part of this process, and understanding your goal, what you hope to achieve is important to have a successful business and not add to that 75%. All right, so now we're going to move on from here and we're going to talk about financial readiness. So when buyers look at a business, they're not just asking, how much cash flow does this company produce? They're asking, can I trust the cash flow? Can I verify it? Can I reasonably expect it to continue after closing? That's a huge concern for a buyer. And credibility when it comes to your financials is one of the most important factors in selling a business, because it's the first lens, it's the first area that your buyer's looking at through the lens of how can I trust this business? What are the value drivers of this business? Buyer, lender, and advisor, they're going to normally look at four different things. First, can the earnings be verified? Can I trust the numbers? Can I trust what the profit and loss tells me compared to the tax return? Can I trust the balance sheet? Can I trust the bank activity? And whenever they feel like that there's a credibility issue there, it creates doubt. And then that can affect the transition and transfer of the business. The second are the add backs documented and reasonable, and can they be substantiated? So every business has a set of financials for taxes. What we want to present is a set of financials that show the operations of the business, the true cash flow of the business. So what we do then is we add back certain expenses. Sometimes you add back owner compensation and benefits, travel expenses if it was something where you were able to do it to write it off for taxes, but it's really not necessary for the operations of the business. Maybe you have a vehicle that you run through the business. The other thing is one-time expenses and discretionary expenses. So maybe you added a new CRM system to your business, and this was a one-time expense. Maybe you're working with a coach to help you scale and grow. You can add back that expense. And so you don't want to have a business that looks like you're running your business like an ATM. That's where you have credibility issues, but it is okay to add back certain expenses. You just need to make sure that they can be documented and that they're reasonable. I'm not going to argue with a buyer over 50 different add backs, but I'll argue over 5. So, this is where your advisor can help you to set that up properly. And then third, is a working capital needs predictable? Can that buyer feel comfortable when they buy your business that they can meet payroll that first month? That they feel like that they can continue to operate the business? Does the business pay for itself? A buyer writes 2 different checks. They write a check for the assets of the business, buying the business, and then they also write a second check sometimes for the operations of the business. If the business does not support itself, if you're just breaking even, that can create problems for the buyer, because a buyer looks through 2 lenses. What is the return on investment of buying this business? And what are the risks involved? And if your business doesn't check both of those objectives, it's worth less. And often the deal structure is created to protect that buyer. And then the fourth thing is, are the trends explainable? Is it not based off of future cash flow? Aggie and Christy and I were just talking about a valuation that was done that was just ridiculous, because the advisor was looking at it just off of the future cash flow that it could generate. Well, a buyer cares about that, but they care mostly about the historical trends of the business. How has it been performing? Where is it going? What's the trajectory of revenue and growth? So this is where many sellers get surprised, because the business might be profitable, but if the business story is messy or inconsistent or even hard to prove, the buyer will usually see more risk. And then what will happen is that buyer is going to either reduce the purchase price, change the deal structure, you're going to get less cash at closing, or they're going to ask the seller for more skin in the game. Even more important, they might slow down due diligence. This is where you hear these horror stories of due diligence, after you sign a letter of intent taking 120 days. Well, unless you're doing an SBA loan, it should only take 30 to 60 days. But depending on how credible the buyer feels your financials are and the story of your business, that can affect how many questions they're going to ask. So for this next exercise on page 3, what I want you to do is I want you to write down 3 numbers. Please write down your approximate revenue, your normalized cash flow, and the one adjustment or add back that would need the most support if a buyer was to challenge it. So what I mean by that is, I don't mind adding back an expense for vehicle. If the business owner has ran a vehicle through there and it is not necessary for the operations of the business, I don't mind providing that as an add back. But you need to make sure that you understand that buyer's going to challenge that. the lender's going to challenge that because they might say, well, the buyer might just have a vehicle too. So think about, what is that one adjustment or add back that would need support if that buyer was to challenge that at closing. And don't worry again about getting it perfect. The point is, I want you to start to think like a buyer. What would they need to believe? What would they need to verify? Where would they likely ask more questions? So a strong financial story, it doesn't mean that everything's perfect, especially as small business owners, you're going to have some issues here and there. Most of us do not do gap accounting in a small business environment in a lower market. But it means that the numbers are clear, that they can be supported, and that they're explainable. And that's where if you don't have that, you need to work with an advisor who can help you get there, such as Athena. You need to make sure those financials are clean. Okay, so the next thing that we're going to do now that we've looked at the financial credibility, we're going to move over to the areas that make most businesses more transferable and more valuable beyond, compared with other businesses. We're going to talk about how do you start to look at your business differently. So we're going to actually do a self score. So in the workbook on page number 4, we're going to do exercise number 2. And I want you to do a quick self score on your business across the 8 value drivers. And again, this is just my tool, and there's other tools out there as well. But what I want you to do is not overthink it, because this is not a formal valuation. It's not meant to be perfect. What we want to do here is we want to quickly identify where are the biggest constraints in your business. And so for each driver, you're going to score yourself 1 to 5. A 1 means there's major risk. It needs significant work. A 3 means it's okay. You know, there's probably some inconsistency, or maybe there's some things you can work on, but it's all right. And then a 5 means it's a true strength of your business, and it would actually help to support the value in a buyer's eyes. So move through this quickly. Just use your instinct. If you're stuck between 2 numbers, just choose the lower one, because buyers are usually going to underwrite risk more conservatively than you're going to. So let's try to look through the lens of a buyer. Let's look at your business the way a buyer would. And then once you've scored all 8 of those drivers, I want you to circle your lowest value driver score. And the reason we're doing that is that's likely the highest, that's one of the highest areas that you should start to work on and improve upon before you're going to exit your business. And then I want you to put a star next to the one driver that, if improved, it would matter the most to the buyer. Think like a buyer. So, for instance, for some of us, most of us, that's often owner dependency. So owner dependency in the value builder language is called hub and spoke. And that's where, unfortunately, you're the decision maker in your business. You're the one that everybody comes to. That's the most common driver that businesses score really low in, because they're like, yeah, I'm still in that place where I'm making all the decisions. But the thing there is that there is a way to be able to fix it. And so that's what we're going to talk about. So I'm just curious, does anybody have questions on this self-score here on the 8 drivers, or anything that anybody wants to share that maybe was surprising to them?
Can
Maybe
you
you scored low in an area you didn't think you would. Yeah, go ahead, please.
can you explain number 4 a little bit better?
Yeah. Number 4, valuation teeter-totter. So that is where, yeah, they didn't do a very good job explaining that, did they? So
Well,
valuation teeter,
it's different on the PDF.
oh, it
Got
is,
like
isn't
little
it?
description. Do
Oh my
risk
goodness.
do
Yeah,
risk
there.
factors outweigh value drivers?
Yeah, okay, thank you. This is the first time I'm doing this presentation, so you guys will be pointing out some things that are wrong here and there. Thank you. So the valuation teeter-totter is where you want a business that you're not taking too much out of the business, so you're not withdrawing in owner draws or salary too much cash flow, but also you don't want a business where you're investing too much, reinvesting too much in the business. A lot of owners make the mistake of reinvesting everything, all profits that they make. And then some business owners make the mistake of drawing everything out of that business. You want like the teeter totter, you want to have balance. You want it to be close, where you're reinvesting, but you're also taking money out of the business. Does that answer your question?
Yeah, thank you.
You're welcome. Any other questions on the value drivers? Okay, great. So now what I want you to do is I want you to look at what you circled and what you starred. And I want you to ask yourself, if you had 6 to 12 months to improve this business before a sale, where would you focus first? That answer is important because the exit readiness is not just about fixing everything. It's about improving the areas that can create the most buyer confidence and reduce the most risk, because that's what a buyer is going to use to reduce value, to make it harder to close, ask more questions, and require more skin in the game. So this is where this exercise is something, this is the first place you can begin. Okay, so now we're going to move on to one of the biggest value driver deal killers. And I already kind of gave it away earlier. And that is owner dependency, hub and spoke. See, buyers are not just buying what the business has done historically, they're trying to understand what will continue after closing. And so when too much of the business depends on one person, one customer, one vendor, or one undocumented process, buyers start to get nervous. It doesn't mean that the business is bad, it means that the buyer sees risk. So, for example, if you are the hub of the business, meaning you're the one that makes all decisions in the business, well, the obvious there is the new buyer's gonna want a longer transition period with you than one that has documented SOPs, documented processes. The staff runs the business for the business owner. The business owner might still be involved from a day-to-day operational decision-making role, but they are not the one that all customers come to. The business does not fall apart. They can go away for 30 days on vacation, come back, and the business survived and thrived, and there wasn't any disruption. One of the other areas that a buyer gets nervous about is key dependency on employees or key dependency on vendors or suppliers. So if you have an employee that is the key person in your business, that buyer is going to want assurance that that key person is going to continue with the business and transfer. And so there's things that you can do to help make the buyer feel more comfortable that that employee will continue with the business. One way to do that is by putting profit sharing in place. After the business sells, being able to have a bonus plan in place that they will share in the success of transferring that business and also in how that business performs after the sale. On supplier and vendors. I saw this during COVID where certain business owners had worked with suppliers overseas, and then when the borders were shut down, they had no way of operating. They literally had no way of conducting business. So it's very important. It's okay if you have that main supplier, but you should have an option B. You should have somebody that you can tell the buyer, listen, if anything happens here, I've already set up my business for success with this other supplier. 3PL providers, I see this a lot of times in businesses where they use a 3PL provider vendor to help take orders and ship orders out from their warehouse. Well, I'll tell you, one of the most common areas I see businesses struggle is with 3PL providers. And so make sure that you're constantly interviewing other providers so that way if you start to see order disruption or they're just not performing the way they used to, make sure that you have a way of being able to move them away from you move your orders over to a new 3PL provider without shutting down your business. Anybody have any questions here on dependency risk and the things that you need to look at and how you can protect your business? Because the next thing that I want to do is exercise number 3. I want you to ask yourself, what would slow down, break, or become confusing if you stepped away for 30 days? So in the workbook on page 5, what I want you to do is I want you to put a red check mark. I want you to put a check mark next to anything that depends too heavily on you, on one person, on one customer, one vendor, or one undocumented process. And so just take a minute to go through and do that. And then the next thing that you can do is you'll notice in the middle column, it says, what is the risk with that dependency? Is it lower? Is it medium? Or is it higher? If it's a higher risk, then I encourage you to start to write out an improvement action. What is something that you can start to do to reduce that risk? So I gave an example of like with the vendors, always make sure you have an option B. So that way the buyer feels more comfortable that you've thought through a contingency plan around risk. The more the more check marks that you have, the more work you're going to have. But it doesn't mean that you have a bad business. It just means that you might have a dependency issue that you can start reducing by documenting processes, transferring relationships, cross-training the team, diversifying customers, or building backup vendor options like I just talked about. Dependency risk will also affect how a buyer views the revenue. And so we're going to move on to that next slide. It's a common mistake that most business owners make, assuming that all revenue is viewed the same by a buyer, and it's not. Buyers are not only asking how much revenue did the business generate, they're also asking how predictable is that revenue? How confident am I that it can transfer after the sale? And how confident am I that it's going to continue after closing? That is the number one concern that I hear buyers bring up when we're negotiating a purchase agreement, well, a letter of intent for sure, but a purchase agreement is I need to make sure that when I buy this business, that it's going to continue. So this is why recurring revenue, repeatable revenue, and project-based revenue are viewed differently. And I'm going to explain to you a little bit how a buyer looks at this. So recurring revenue is usually the most attractive because it's contracted, it's subscription-based, it's retained, it's maintenance-based, it's annuity-like. A buyer can look at it and say, there is some visibility with this revenue into the future cash flow because it's reoccurring. Where repeatable revenue is still very valuable, but it usually carries more risk because customers might come back again and again, but they have to choose to buy from you each time. And so that buyer will want to understand the history, the relationship, the retention pattern. What is the churn? They will want to understand whether those customers are loyal to the company or are they just loyal to the owner? Is there an owner dependency issue? And then project-based revenue, it can be valuable, but it's much harder for a buyer to underwrite. And the reason why is if the revenue depends on the next sale, the next bid, the next referral, the buyer may view it as less predictable. And it doesn't mean, again, that you have a bad business. It just means there's more risk. So it doesn't mean that the business isn't sellable. It means that the buyer is going to ask more questions. You're going to have a longer due diligence period. They might apply a lower multiple on a business like that, or they might require more structure in the deal, more owner financing, more earnout. So what I hope you're taking away from this, the direct point, is that not all revenue earns the same buyer confidence. And so the more predictable and transferable that revenue is, the easier it is for the buyer and lender to support the valuation of the business. And the more uncertain or owner dependent that revenue is, the more risk the buyer sees. And so it's going to be less valuable. So here's a question, and I want you to think about, we're going to be filling out on page 6. I want you to think about what percentage of next year's revenue would a buyer believe is dependable without your daily involvement? And then I want you to think about this through the lens of the buyer. Think about you are the buyer, not what you believe will happen, but what a buyer would believe that they can count on based on contracts, the history, the customer behavior, maybe your team involvement, and most important, proof. That's what they're going to want. They're going to want more sales reports to prove project-based revenue, repeatable revenue than recurring revenue, where it just automatically renews. And so I want you to write down those percentages because this is a very important number. It can tell you how much of the business's future cash flow is easy to believe, and easy to support versus how much explanation, support, and de-risking you need to do in your business in order to reduce that risk. So, think about this again through the lens of the buyer, but most important, think about how you can start to improve the revenue quality in your business. Okay, so now that we know our revenue, we've talked a little bit about the value drivers, we talked about owner dependency, customer dependency, vendor dependency. Now we're going to talk about how do you explain to a buyer how the business will continue to win. And this is what's called the moat around your business. Warren Buffett is probably one of the key investors that I know of that talks about he will not invest in a business that does not have a moat, an investable moat around it. And what that means is it means that it wouldn't be easy for new entrants or competitors to easily copy what you do and take your service or your business overnight. It also helps the buyer to feel more comfortable that the business will continue to grow. There's a difference between differentiation and growth. Buyers want to know why the buyer, a buyer wants to know why the business will continue to operate and win and grow after the owner exits. But most important, they want to understand how. Why do customers buy from you? What do they say? So a strong moat sentence should explain 4 things clearly. The first thing is, who do you serve? You want to be specific about your target customer, not just small businesses or homeowners or companies. What type of customer is the best fit for your business? And then second, what outcome do you help them to achieve? This should be the result of what your customer actually cares about, not just the service that you provide. The third is what is unique? What is unique about your business? This might be a process, it might be expertise, it might be the speed, it might be the relationships, maybe it's your reputation. Maybe you have technology and data that nobody comes close to. It might be your geographic claim that you have in your business, where you're at. But what is that? And then the last thing is What makes it hard to copy? Because this is the proof or the barrier that keeps those competitors from being able to take your business overnight. Buyers don't want to just have, hey, we're so great and see the testimonials. They want evidence. They want proof that your business has something different. So what we're going to do now in the next exercise on page number, should have wrote these down. This will be something I'll add going forward, is we're going to work on our moat sentence on page number 7. And so what I want you to do is I want you to think about we help, but think about who you serve. Again, don't just use, small business customers, homeowners. Who do you serve? A strong moat sentence would be something like this. We help multi-location healthcare practices reduce patient scheduling delays through specialized intake process and trained support team that competitors cannot easily copy because our documented workflows, industry-specific data, and long-standing referral relationships versus we provide great service to our customers. That might be true, but it's a little too generic. So think about who do you help? What do you help them to achieve? What's the outcome they care about? What is the unique capability of the company? So you help them achieve through whatever it is that you do that's unique. And then the final thing is the proof. Competitors can't copy this because this is the reason why we have an advantage. And you can come back to this too. And what I also want you to do is I want you to test your sentence. So I want you to look at it and I want you to think about, does your sentence claim, is it just claims or does your sentence provide proof that it is repeat, that it is something that can be counted on? It's not something a competitor can just take overnight. The goal isn't to be fancy, even though, there's a lot of words in my premium moat sentence that I just read to you, but the goal is make it simple but true and hard to argue with. And so think about how you can stand out and how you can convey that to a buyer. Okay, so the last thing that we're going to talk about here is diligence. And this is an area that is very important. This is probably one of the most, out of all the deal killers, this is probably the number one. This is where I see buyers that go, yeah, this is too much work, or I don't have confidence in what's been provided to me. Clean diligence helps to reduce buyer uncertainty. And diligence is not just a document request. It's the buyer's attempt to be able to prove but verify the information you've given to them. Can they trust the numbers? Can this business operate without the owner? Does the buyer believe that there's a viable path forward after closing? Do they believe in this? And normally, deal readiness will fall into 3 different buckets. The first bucket is the financial package. So buyers want tax returns to match their profit and loss statements. They want to be able to make sure that you've reconciled your balance sheet. They want to be able to make sure that they can prove the bank activity against the activity in your accounting system and what you've reported to them on the profit and loss statements. The more doubt that a buyer has around financial credibility, I assure you, the harder it's going to be to close. And they are going to dig in and they are going to ask a lot of questions. Quality of earning reviews are something that normally do not happen in lower markets, but I've noticed those happening more and more. Quality of earnings review is really just one step below an audit. I mean, I have one business right now where I have 6 due diligence checklists. And the reason why the buyer is doing that thorough of investigation is because there was some credibility trust issues. They couldn't validate some of the information. The owner couldn't validate some of the questions that the buyer had. The second bucket is the operational proof. And this is where the buyer is asking, how does the system, how does the business actually run? They might want to see an org chart. They might want to see roles and responsibilities. They're definitely going to want to see standard operating procedures if you have that written down. They're going to want to see contracts, leases, KPIs. Really, what they're doing is it's helping them to understand whether the business is transferable and scalable. And then the third bucket is a transition story. Yeah, Annie,
I apologize, but can
that's
you
okay.
define what is a KPI?
Yeah, KPIs are key performance indicators. And you can pull KPIs for your industry that often will be even narrowed down to the size of your business. And there's certain metrics that you should track. And like Christy and Aggie, they would be a great resource to help you figure out what are those metrics you should be tracking. It helps you to stay more, it helps you with profitability, it helps you to grow, and it helps you, most importantly, to convey to a buyer, here's how my business performs compared to in my industry and to my competitors. So, really important. Thank you. Appreciate that question. The third bucket is that transition story. The buyer needs to understand, what does that look like with the transfer? How is the management team going to transfer? What training and onboarding is going to look like? What are the current growth initiatives in the business that the buyer can duplicate? This is especially important if the buyer has been central to the decision making. You want to be able to showcase to the buyer, hey, I have been the hub and spoke of my business, but here's some of the things that I've done to help with the transfer of the business. So, what we're going to do is we're going to take a minute and we're going to look at how can you start to create a supportable due diligence uh, storage of the information preparing for exit. So, what I mean by that is don't wait to due diligence to pull this all together. You can start to put this in folders now and organize it. It will make you look more professional. So, what I want you to do is, I want you to go through the three different buckets that I have here, and I want you to check mark those that you will need to provide to a buyer. And I want you to think about, if a buyer asks for this tomorrow, which bucket would be hardest for you to support? Would it be the financial package, the operational proof, or the transition story? And then what you're going to do is you're going to start to work on that. You can start to work on getting that information ready, organizing that evidence before it comes time for the diligence. It will change the way that a buyer looks at your business as far as credibility and trust. All right. And then the last thing, I know this is a lot, and we're running out of time here now because there's quite a bit that I wanted to cover with you. But what I want you to do is I want you to have a goal leaving this with not 20 things to fix, which is overwhelming. But I want you to have a goal to choose a few actions to start to execute. So, what I want you to do on page number 9 is I want you to first identify one financial proof gap that you can fix. That could be documenting add backs, reconciling financial statements, cleaning up reporting, organizing tax returns, having a better cash flow story. And then, second, I want you to identify one dependency that you can start to reduce. That might mean delegating, to someone else. That might be documenting using standard operating procedures. That might mean cross-training an employee or independent contractor. It might be putting a new system in place. And then third, I want you to identify one way to be able to strengthen your revenue quality. And this would be, should you look at a way of creating recurring revenue? Is there a way to add more credibility if you are project based to the giving assurance to that buyer that that revenue will continue? And then fourth, I want you to identify one growth story that you can clarify. So that might mean, that you're going to work on defining the expansion story. It might mean that you're going to document, how your business has customer demand. It might mean that, you're providing a business plan to that buyer to be able to show them, here's how you can continue to grow after you step away from the business. And then the final thing is after you write down the specific actions, who's going to be the owner of those actions, and then how you're going to have evidence that you've completed that specific action. I want you to write down at the bottom of the page, in the next 90 days, I will improve blank by doing blank. And I want you to make it specific enough so that you would know whether it was completed. So make sure, that you don't just write down, something generic, but you've actually given an action to be able to fix it. So I'm going to end with this. Exit readiness is not a one-time event. It's an ongoing value proposition, protection. And whether you're going to sell in 1 year, 5 years, 10 years, or not ever, I'm telling you that this is the secret sauce that not only will help your business to be more profitable, but also to give you more freedom in your business. It's really important. And so the closing thought is, if you haven't already done this, look at assessments that you can take on your, to help you understand your business, understand the areas that you need to work on, and then go through this exercise again and put some time into it and really think about it. So I thank you, and I'm happy to answer any final questions, and hope that this has been helpful for getting your business ready to exit.
That's so good, Marla. Thank you.
Thank you.
Anybody has any questions? We have 2 minutes, minute and a half, maybe. Well, you flabbergasted them, Marla.
Or overwhelmed them. I hope I didn't do that.
I'll say flabbergasted because it's a compliment.
One thing I'll leave you with just before we close, please don't let this feel overwhelming. It is a lot if you have a lot to do, but I'm telling you, just start in one area. It will make the world of difference in your business. I promise you that. It will be worth your time. So reach out to me if you have any questions after the later. I'm at marla@biznavigators.com, or you can reach out to Christy or Aggie.
We'll connect.
Sounds good.
Thank you so much, Marla. Thank you all for making the time to be here as well, and for your participation. And hope you all have a wonderful rest of your day.
Thank you.
Thanks, everybody. Take care.
Bye-bye.
Good to see you.
Bye.
Bye.